could have on fund flows back home and globally as well. We have Rob Subbaraman, Head of Global Macro Research at Nomura, joining us. And Rob, hi. Thanks for your time today. First up, give us a sense of what you have made of these comments that we've heard at Jackson Hole, a possible rate cut in September. Do you predict that could happen? And if yes, do you believe that a rally of rate cuts could continue for the coming months as well for the Fed?
Yes, I think Jay Powell's comments at Jackson Hole pretty much endorsed market pricing for a rate cut at the September FOMC. Powell talked about how there is upside risk to inflation and downside risk to employment growth. But if you look at what he said beyond that, he said that if the downside risk to employment growth materialize, the risk is that the unemployment rate could rise quite sharply. Whereas for the upside risk to inflation, he talked about how it's likely to be a one-off rise in the price level, and so it may not lead to lasting inflation. So I think the market took from all that the Fed's got this unwelcome trade-off: upside risk to inflation, downside risk to growth and employment. But they're starting to focus a bit more on the downside risk, and we would agree with that. And so we do expect the Fed to cut rates at the September FOMC.
Interesting. And do you think that's just the beginning of it all, Rob? And are we likely to see more rate cuts in the offing post-September too?
Well, look, it's still early days. And, even for the September FOMC meeting, we have another CPI report, another non-farm payrolls report before the September FOMC. And Powell, was very clear to say that the Fed is not on any preset trajectory and that they are very data dependent. So we're watching the data. And, further out, it's still, I think, quite uncertain given this trade-off of inflation risks upside and growth risks on the downside. The view we have at Nomura is the Fed is going to be on a kind of gradual and cautious rate cutting cycle. So we don't think, the Fed's going to be rushing to do 50 basis point cuts, or is going to be cutting at every meeting in the next 6 to 9 months. Our view is the cut in September, and then after that, we could get a cut in December and another cut in March, and that would be about it. So, we have 3 cuts in our forecast horizon, 75 basis points in total, and that's a bit less than what the market is currently pricing. And that's partly because we do think inflation is going to stay fairly sticky, and we think the US economy overall is going to end up to be reasonably resilient. We don't have the US economy, for instance, going into recession on our forecasts.
So what is the view here on India then, Rob? Because what we're working with right now is, that deadline month end this week itself, wherein Trump's 50% tariffs are going to be implemented. You think growth negative, or do you think all that the government is doing at their end, that is the renewed reform push that we've seen from the government? There is talk about GST rationalization as well. The pay commission delays, it seems that more rate cuts could be in the offing. And, you've clearly got the central bank supporting that vision of, kicking back demand as well and not worrying about what the fisc burden is going to be right now. Do you think that's going to manage to balance it all?
Yeah, I think it is really interesting right now. So August 27 deadline for this penalty 25% tariff. That would take the overall US tariff on India to 50%. For certain Indian goods exported to the US, that will be almost like an embargo. It'll be a sudden stop. It's not profitable to export. So we do think there will be a pretty big hit to exports. Interestingly, when we poll investors, Nomura's clients, a lot of them don't expect this penalty tariff to actually be implemented. There's still many clients that are skeptical the US will do it. So, it could still be a bit of a surprise for markets if the US follows through. We think there is a big risk that the US does follow through. As you say, I think the Indian government is being very quick to look at policies to try and offset weaker exports going forward. The GST rationalization, there's a lot of moves to try to ease the cost of doing business and deregulation and subsidize exporters. So, overall, our view is there is going to be some hit to GDP growth, but not as big as it could have been because of the government's very quick and good policy response. So we're forecasting India GDP growth for this FY26 to be 6.2%. We've now lowered that to 6.0%. And I would say the risks are still on the downside, but 6% growth, all things considered, with the US imposing much higher tariffs than many people had thought on India, is still a reasonably good outcome for India in our view.
Well, indeed, but Rob, yes, of course, the tariff uncertainty does remain for the Indian markets. But with respect to the GST push, have you made any adjustments to your GDP forecast? Any sort of an uptick that you are expecting with respect to the GST?
So as I said, we've tried to balance the slowdown in exports because of the tariffs with the GST rationalization, and the net effect of both of those is we've lowered our GDP growth forecast from 6.2 to 6%. There is a lot of speculation in the market that the GST rationalization and these efforts to support domestic demand could lead to a significantly wider budget deficit from the budgeted 4.4% of GDP. We're not so sure about that. We think the government is very keen on maintaining macro stability, and we think efforts will be put in place to try to ensure the budget deficit does not widen much. And that is our forecast, that it will not widen that much. The other thing I would say on monetary policy, the GST and all these measures could actually contribute to keeping inflation low. Our forecast for CPI inflation is 2.7% this FY26, which is lower than the RBI's forecast. And we think that will open the window for the RBI to cut rates 2 more times before the end of this year.
I want to understand, Rob, what your sense is about China, because, like you also mentioned in your note, that despite a decent growth that one has seen in first half, they run a high risk of demand slowdown purely because of, the situation with US. And also the entire India-China angle too. While they seem to be, building the bridges right now, but it's more about who loses on business and who gains on that.
Yeah, so we do feel that even though the Chinese equity market is having a strong rally, we do feel that this is decoupling from the economy and China growth, which we expect to slow fairly sharply in the second half of this year to around 4% growth. And that's partly because of a lot of demand, whether it's exports or retail sales. We're front-loaded in the first half of this year, and there'll be payback in the second half of the year. There's also an austerity program going on for civil servants, and there is also the efforts to crack down on overcapacity, particularly in some sustainable energy industries like electric vehicles. All these things we think will weigh on growth in the second half of the year. And I'd also point out that the property market crisis, a very weak property market, remains still under considerable pressure. When it comes to India, China, I think it is interesting that both are facing common pressures from the US. And there is the potential that this brings China and India a bit closer together, Already we're seeing some signs of this, I would say very incipient signs, but it does look like Prime Minister Modi will be visiting China very soon. There's news that China and India direct flights may resume soon. Maybe we will see more signs of increasing economic ties between China and India when it comes to exports and investment.
But Rob, with respect to the Jackson Hole Symposium, the other impact that we have seen was also on the dollar index, a bit of a cool off from those highest level, and that actually bodes well for the emerging markets as well. What is your sense that where maybe the index is headed from these levels? Can we see a bit of a more cool off?
Yeah, so our view on the DXY and the dollar index is that we're going to see in the second half of the year some further softening in the US dollar. I talked about how we expect the Fed to cut rates, resume its rate cutting cycle. We think that will be kind of a bit dollar negative. And I'd also point out that for well over a decade, foreign investors have plowed a lot of money into US dollar assets. And with the US economy slowing and some other places like Europe, for instance, showing signs of stabilizing and many EM economies growing at a reasonable pace, we do think there could be, in terms of the incremental additional foreign investments, maybe a bit more going towards EM in the second half of the year relative to the US.
Interesting. Rob, great to have you today and great to get in all that insight.
Thanks very much for having me.